So next we're going to go over what kind of requirements there are to submit an offer. We want to make sure that the offer is processable, because if it isn't, we're wasting our taxpayers' time, and we want to make sure that it's able to be processed in order to even start it through those phases of seeing if it can be accepted. So first and foremost, and these are things that we check before we submit one, of course, are they in compliance? So you need to probably check with the IRS and say, okay, which returns are you going to require for us to file, or has my taxpayer filed all those? You can call and ask for a compliance check is what you would ask for, usually if you're calling tax practitioner priority hotline. So all the required returns must be filed, and a substitute for return, that's what SFR is, where they take it upon themselves to file a return for a taxpayer that hasn't. That's okay, and they won't require a return for that because they can go ahead and collect for it. Usually in the past they will allow 30 days to comply, but we'll talk about a little bit of a subtle change that they've just made. But make sure that you have all those required returns in before you submit an offer, quite simply. If they have to pay estimated taxes the current year, so right now if we're submitting this in 2017, they need to be current with all their estimated taxes for this year, and that's all of them. First quarter, second quarter, third quarter, all year, they have to be current. And you have to enclose documentation. You have to prove those payments. They're not just going to take your word at, yeah, they've made their payments. You have to prove it. Sometimes when you're already in working with the offer unit, they'll allow you an opportunity to correct it, but again, make sure that's what you have going on before you even submit it. If they're a business owner, all their business returns and payroll tax returns and everything appropriate, they're filed. They're filed timely, and the payroll tax deposits for the quarter that you are filing the offer in are all being paid, or trust funds paid. The trust fund recovery penalty assessed. They're looking to say, at this moment in time, are you current, and we're not pyramiding this anymore? If the taxpayer is in bankruptcy, you want to check that. Automatically, if they're in bankruptcy, it's ineligible. The offer cannot be processable. It's because the bankruptcy stops collection, and they have no opportunity to even consider an offer or not, because they're not in collections at that moment. We also have to consider carefully if they have the ability to pay in full. Now, that may sound like an odd question if we're talking about a status to collectability offer, but we have to consider the statute of limitations. So just giving you a quick example, if we run through the calculations and find out our taxpayer has $1,000 a month of available income, and let's say they have 84 months left on the statute of limitations that the IRS could collect from them, which the statute is for collections 10 years from the date of assessment. There's little adjustments here and there too, but 84 months. So they would take 84 months and say, well, 84 months times $1,000, we could get $84,000 out of this person if they make payments over time. If you are saying, well, I would like to, show you that I can do an offer of $50,000, they're going to go, well, actually, no, $84,000 is what you could pay over time. That's a little problematic. That wouldn't be a very good offer to be processable. If $50,000 is the total tax they owe, they go, well, yeah, we could get it. If instead they owed $100,000 and they could only pay $84,000 if they paid it out over time for as long as the IRS could collect from them, they'll go, yeah, we're not going to get it out of them. We're going to have to consider an offer. So that's a very important consideration that you need to make before moving forward. So the second thing is, if you make an offer and it requires, payments, you're making an offer and saying, I promise to pay the X amount per month, even while they're considering the offer. If you're doing a periodic payment, you've got to make sure they make those payments. They miss one payment. First of all, if you don't make the payments with it, they could just return it to you and say it's unprocessable. You didn't make your payment. If it's already in the works, it's kind of being processed, and you fail to make a payment, they could return it to you and say, oh, you must be withdrawing this offer. So it's so important to make sure they never miss one of those payment requirements, because the IRS will still keep the money. Your deposits, your payments you've submitted to them, they're going to just go ahead and apply it towards tax that you've paid. But if you fail to make one, they'll go, oh, you're just withdrawing the offer. Thanks for making these payments on your past due amounts. A couple new changes to keep in mind for 2017. Starting March 27th to 17th, so this is not that many months ago, they're just going to go ahead and return any newly offer and compromise if all those tax returns are not filed. So that's why I said this is a newer change, so make sure those returns are filed before you even submit it. They're just going to return it to you. And in this case, they say they're going to return the application fee, but be careful, because in the past they have kept those quite often. And they said they're just going to keep that initial payment anyway and put that towards tax owing. So You're not going to have a happy client if you know ahead of time they're going to reject that offer to you and keep that taxpayer's deposit they've put towards this offer. So pay attention to that. There's also a recent TIGDA report. So this recently came out in October, and I have a reference there for you if you're wanting to check that out. It was recommended to the IRS that they remind their employees they're supposed to process an offer within 16 days. Now, processing does not mean accepting or that part of it, just giving it a stamp, a number saying, okay, you're in the offer unit now, or rejecting it if you don't meet the requirements. And they're supposed to reach out to the taxpayer or contact within 120 days. So this is just a reminder to them, hey guys, this is our time frames that you should be working within. And they're supposed to send a letter if they can't contact their taxpayer within 120 days. They're also supposed to verify that alternative resolution is discussed with them if they cannot accept the offer. So what did they do? They actually agreed with the recommendations. So will it help with process times? It's the goal and the intent anyway, but we'll have to wait and see what this does for us. The truth is right now that in the offer unit, kind of from start to finish, we're seeing anywhere about a 4-month on the quicker time frame, probably because we had great information for them, upwards of 6 to 8 months on the longer end. So it's a few months out. It's not a very quick process. What are the good and bad, the pros and cons of the offer program? First of all, definitely it's great for the taxpayer. It's a permanent contract unless they violate the terms, provides them a fresh start, reduces liability, and stops collection activity the moment that you file an offer. But on the bad side, we got to pay attention to statute of limitation considerations. What do I mean by that? The moment we submit an offer, because it stops collection, it's called tolling in IRS speak, it stops that statute of limitations. They have 10 years to collect from somebody that owes. Now we're going to add, for the whole time that offer is pending, plus 30 days. So what you're ending up doing is you're adding time to their clock, so that's going to be much longer in the future if this plan doesn't work. Now, normally you want to submit an offer you believe has a pretty good chance of success. You can never promise to a client that, oh yeah, this is guaranteed, because you're misrepresenting. It's still within the IRS's ability to accept or deny that. One of the things you have to pay attention to as well is future noncompliance. The moment they submit an offer, if that's accepted, they're on the hook to be on good behavior. They have to file all of their returns on time in the future for 5 years. They have to make sure that there are no balances owing. They have to pay their tax in full on time for 5 years. If they mess that up, it may actually void their offer, and all that tax will come back. Even though you had it accepted, they have to be on kind of like probation, you could say, for 5 years. Have to prove that they're going to be a good taxpayer from now on. And if it's voided, you've just provided the IRS a complete roadmap to all of that taxpayer stuff. So they know what kind of assets and bank accounts and where to get what they need out of that taxpayer if they have to. The next thing to keep them aware of is that their refunds, if they have a refund from their tax return, the year you submit that offer, the IRS is going to keep that refund, and it's not going to be a payment towards the offer. It's not going to be anything but just, oh, thanks, we'll apply this to some of the past due tax. It doesn't count towards anything, but they're not going to get that refund. The next year after, like the offer is accepted, they'll get that refund. Even if they're on probation, they'll get refunds for the next years, but that first one they're going to keep. And the IRS has the power to still file a tax lien. A tax lien is not a collection item. I know that sounds strange, but they can file a tax lien even if you have an offer that's being considered.